Imagine missing your expected earnings target by a single penny, but somehow using that exact same 3-month window to just completely revolutionize your financial standing, like building a massive billion-dollar war chest.
Right, which is just a massive contradiction.
It really is. And that is exactly the contradiction we are unpacking today. So welcome to this deep dive into Equinox Gold's Q1 2026 earnings report. We are also combining this with the, frankly, incredibly revealing transcript from their latest earnings call.
Yeah, it's a great set of sources.
And our mission today is to give you a shortcut to understanding how a major mining company fundamentally restructures its entire balance sheet, battles extreme weather just to pull rocks out of the ground, and, navigates high-stakes community negotiations.
All while the global gold market is behaving just wildly.
Exactly, wildly.
It really requires throwing out the whole the traditional pass or fail grading system we use for quarterly earnings. Because you get these surface level numbers that tell one very narrow story, right? But the underlying mechanics are revealing a masterclass in corporate maneuvering under intense pressure.
Okay, let's unpack this. Because the hook right at the top of these sources is, well, it's jarring. Equinox was expected to hit 29 cents in earnings per share.
Right.
And they came in at 28 cents. So if you just casually glance at the headline, you might assume they had a rough, maybe sluggish quarter.
You'd think they missed the mark.
Right. But looking past that 1 cent miss, they generated $527 million in adjusted EBITDA and are suddenly sitting on nearly $1 billion in available liquidity.
Which is staggering. And for those of you who don't spend all day staring at accounting spreadsheets, EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right.
It's basically the raw, hard cash generated from daily operations before the accountants, apply all the complex structural costs.
So how does a slight earnings miss hide $500 million in raw cash generation?
Well, to understand Q1 2026 for Equinox, you really have to look at the massive strategic pivot they just executed. It is not just about what they mined this quarter.
Okay.
The focus is entirely on what they sold and what they paid off. If you only look at the gold they physically dug out of the ground, you are missing the actual strategic maneuver here.
So the real story is $1 billion house cleaning.
Exactly. A massive house cleaning.
So before a massive industrial company can effectively dig into the earth, they apparently have to dig their way out of debt. Let's look at this balance sheet overhaul because it dominated the entire first quarter. Equinox sold off what they call their Brazil operations.
Yeah, the Brazil operation.
And this included the Aurizona mine, the Bahia complex, and the RDM mine.
And that sale was completely transformative for their capital structure. I mean, they walked away with $845 million in net cash proceeds.
Wow.
Yeah, and beyond just the cash, they recognized a massive $105.6 million gain on the sale itself.
So having almost $1 billion in sudden cash is it's a great problem to have.
Oh, for sure.
And they didn't just sit on it to make their bank accounts look impressive to investors. They took a flamethrower to their corporate debt.
They really did.
The sources show they repaid a staggering $990 million. They completely wiped out a $500 million term loan.
Right.
And they wiped out a $261.3 million loan with Sprott Resource Lending.
Which is an incredibly aggressive financial posture. It's so aggressive that they willingly took a $16.6 million, what they call an extinguishment loss, just to eliminate that Sprott loan ahead of schedule.
Right. That extinguishment loss is a fascinating detail to me. Think of it like deciding to break a 30-year mortgage on a giant, expensive vacation home so you can pay it off completely.
Right. The bank wants that interest.
Yeah. Exactly. The bank was banking on years and years of your interest payments. So when you walk in and hand them a giant check to clear the debt early, they hit you with a massive early repayment penalty fee.
Which hurts in the moment.
Yeah. That penalty is your extinguishment loss. But Equinox clearly did the math, right? And they realized that paying a $16 million penalty today saves them a massive amount of high-interest carrying costs tomorrow.
Yeah, the long-term savings are huge.
And because they sold those Brazilian assets for such a great price, they had enough leftover cash to finally start paying their shareholders a direct allowance.
Yeah, right after settling that debt, they initiated a share buyback. They repurchased over 300,000 shares for $4.7 million.
Wow.
And they paid their inaugural dividend of $11.8 million.
So if we connect this to the bigger picture, By aggressively deleveraging, by eliminating those high-interest loans, Equinox was able to completely renegotiate the remaining debt.
Exactly. They refinanced their revolving credit facility, which actually lowered their interest rates down to SOFR plus 1.45% to 2.50%.
Okay, let's clarify SOFR for anyone who isn't a corporate banker. That's the secured overnight financing rate, right?
That's right.
It's essentially the baseline interest rate that massive banks use to lend to each other.
It is the absolute bedrock of corporate lending. So if a syndicate of banks is willing to lend to Equinox at just 1.45% above that absolute baseline rate,
It's practically nothing.
right, the banking sector is basically looking at this mining operation and declaring it incredibly low risk.
Which is huge for a mining company.
It is. And furthermore, they extended the maturity date of that facility all the way out to 2030. So they built themselves comprehensive financial armor.
They reduce their required carrying costs, push their repayment deadlines years into the future.
Yep. And definitively prove to the market they have the capital discipline to actually return value to shareholders via those dividends and buybacks.
Okay, but financial armor is great for the boardroom. All that financial armor doesn't mean much if you can't physically get the gold out of the frozen ground.
No, it does not.
Money cannot control the weather, or the actual geometry of the rock, for that matter.
Right. This is exactly where the frictionless world of high finance crashes into the freezing reality of heavy industry.
And the sources lay out the physical reality pretty clearly. Across the whole company, they pulled out 197,000 ounces of gold this quarter.
Which is solid.
Yeah, and their baseline cost to dig a single ounce out, what they call the cash cost, was $1,633.
But then you have to factor in the overhead.
Exactly. Once you factor in all the necessary corporate upkeep, administrative overhead, and the ongoing exploration just to keep the mines alive, what the industry calls the all-in sustaining cost, or AISC, they were spending $1,950 per ounce.
And before we get to the struggle in Canada, we really have to look at Nicaragua.
Oh, yeah. Nicaragua.
The operational data shows Nicaragua was the unsung hero of Q1. They delivered a record 81,000 ounces.
Having a steady, high-performing asset like that in a diversified global portfolio is just crucial. Nicaragua was the anchor that offset the severe growing pains they experienced at their newer mines.
Yeah, the real drama during the earnings call centered directly on those newer Canadian operations.
The Greenstone and Valentine mines.
Exactly. Both are in their ramp-up phases. Valentine just had its first full quarter of commercial production, putting out 27,000 ounces.
But they got completely sidelined by a severe Newfoundland winter.
Yeah. And in the context of a massive open-pit mine, a severe winter doesn't just mean the operators are wearing thicker coats.
Right. It's not just a chilly day.
No, 10 feet of snow fundamentally changes the physics and the accessibility of the entire operation.
There is a very revealing exchange in the Q&A transcript that highlights this perfectly. An analyst named Wayne Lamb asked management about grade reconciliation at the Valentine mine.
Which is a very polite way of asking a tough question.
Right. In plain English, he was asking, why isn't the rock you're pulling out as rich in gold as your geological models predicted?
And management's answer was brutally honest.
They admitted that the massive winter snowstorms physically blocked their heavy machinery from reaching the planned high-grade ore zones deep in the pit.
Right. They just couldn't get the trucks down there.
Because the mill still needs to run, they were forced into early-stage mining practices, basically feeding lower quality, easily accessible rock into the machine. They referred to it as dilution.
Yeah, dilution. The rock they fed the machine wasn't great, but the machinery itself actually performed phenomenally well.
Oh.
Yeah, once that lower-grade dirt actually made it into the processing plant, the mill proved to be a beast.
I saw that in the notes.
Following a planned 7-day maintenance shutdown in April, the Valentine mill ran at 124% of its nameplate capacity. It was churning through nearly 8,500 tons of rock per day.
Wait, let me think about this for a second. If the processing plant is running at 124% capacity, meaning it is chewing through rock a quarter faster than the engineers even designed it to,
Right.
why did the unit costs go up? I was looking at the earnings report, and the cost to produce a single ounce was higher than expected. Usually in manufacturing, if you run a machine at super high capacity, your cost per unit drops because of efficiency.
That is the exact paradox the financial analysts pushed on during the call. And the chief financial officer, Peter Hardy, addressed it by explaining the denominator effect.
Okay, let me guess. If you picture a fraction, The numerator is the total cash they burned running the mine.
Yep.
And the denominator is the total ounces of gold they actually produce.
Exactly. And Hardy noted that the total spending in the numerator was incredibly disciplined. They stayed within 1% of their budget.
Oh, okay, so they didn't overspend at all.
Not at all. The problem was the denominator shrinking. Because the snow stopped the trucks from reaching the good ore, they processed a mountain of dirt, but pulled out significantly fewer ounces of gold.
You've nailed it. So if you spend your exact expected budget, but you pull out 15% less gold because you were forced to process diluted, snow-covered rock,
Your cost per ounce mathematically spikes.
it has to.
Right. The machinery is working flawlessly, the corporate budget is tight, but Mother Nature dictated the geological quality of the dirt they were allowed to process that specific quarter.
So as the weather clears and they regain access to the higher grade ore, that denominator of produced ounces will grow.
And the cost per ounce will drop right back into alignment with their technical models.
Okay, so you can engineer a perfect extraction machine, but if you have to feed it subpar dirt because the high grade stuff is buried under a Newfoundland blizzard, your margins are going to suffer.
They absolutely will.
So fixing that denominator at Valentine over the long term and insulating the operation from future storms, that requires an expansion. It requires moving into phase 2.
And expanding a major mine, or restarting a dormant one, requires significantly more than just buying bigger bulldozers.
Right.
It requires human permission. The industry calls it securing a social license to operate. Without it, you do not have a mine. You just have an incredibly expensive piece of fenced-off land.
Which brings us to their growth pipeline and community negotiations. Because to smooth out that lumpy rock grade at Valentine, Equinox is already committing funds to procure long lead items for a phase 2 expansion.
Yeah, they want to scale their capacity to 5 million tons.
And at their other Canadian site, Greenstone, management clarified to analyst Anita Soni that they are budgeting roughly $80 million in capital expenditures for 2026. This is specifically to build a shear key for their tailings facility.
Yeah, shear key. And to give you a visual on that, a shear key isn't like a piece of equipment.
Right.
It is a massive, highly engineered trench filled with compacted material, built deep into the earth at the base of a dam.
Oh, wow.
Yeah, it prevents the enormous weight of the waste storage, the tailings from sliding or failing. It is a foundational, non-negotiable investment in long-term environmental safety.
But the absolute most fascinating long-term play in this entire earnings report isn't up in the Canadian snow.
No, it's not.
It's down in Mexico, the Los Filos mine. And to put this asset into perspective for you, it has a staggering 16 million ounce gold resource.
Which is just massive.
At today's gold prices, you are looking at roughly $37 billion worth of gold sitting in the ground.
Incredible.
During the call, analyst Jeremy Hoy asked CEO Darren Hall about restarting operations there, and Hall's response was incredibly deliberate.
He noted they have already ratified new long-term agreements with 2 of the 3 local communities.
Right, and the dialogue with the final community is highly constructive.
What's fascinating here is the dual-track strategy Equinox is employing. Management is concurrently working with an EPC company, an engineering, procurement, and construction firm, to design the full scope of a brand-new CIL processing plant.
At the exact same time, they are negotiating with that third community.
Exactly.
I saw that acronym, CIL, carbon and leach, right?
Yes, and it's a major technological upgrade. Instead of just piling crushed rock on a pad and spraying it, which is an older method, a CIL plant uses a series of massive tanks.
Ah, okay.
They use a liquid cyanide solution to dissolve the gold directly out of the ore slurry and simultaneously introduce activated carbon to absorb the dissolved gold.
So it's much more efficient.
Oh, vastly. It's a highly efficient, contained chemical extraction facility that maximizes recovery.
But designing a plant like that takes massive upfront capital, and CEO Darren Hall preached extreme patience here. He specifically stated they are in no rush to turn the old machines back on under the legacy operating terms.
Yeah, they want a fresh start.
Instead, Equinox wants to establish a comprehensive 20 to 30-year life plan that produces 300,000 to 400,000 ounces a year. I kept thinking about it in real estate terms.
How so?
Well, it's the difference between hastily signing a 1-year lease on a house with a collapsing roof just so you have a place to sleep tonight versus taking 6 months to patiently negotiate a 30-year mortgage on a newly renovated mansion.
That's a great way to put it.
You simply do not rush the extraction of a $37 billion asset.
No, you don't. And by funding the engineering of that state-of-the-art CIL plant while they negotiate, they are tangibly showing those local communities that they are committed to a win-win durable investment.
They're putting their money where their mouth is.
Exactly. They are signaling that they intend to build infrastructure that lasts decades, providing generational employment.
Yeah.
And this is regardless of whatever short-term fluctuations happen in the spot price of gold.
It completely shifts the dynamic from a short-term extractive transaction to a long-term economic partnership.
It does. And the spot price of gold is the perfect pivot point here.
Yeah.
Because digging the gold out of the ground and negotiating with communities is really only half the battle.
The other half is actually selling that physical metal in a completely chaotic global market.
And the current macroeconomic environment is the definition of chaotic.
It absolutely is. I mean, to illustrate just how tense the market is, let's look at one of the financial advertisements that was captured alongside our source material for this deep dive.
Oh, right.
The ad featured a massive, jarring headline. The Iran war just broke the gold market.
Wow.
Yeah, and it went on to describe defense stocks exploding in value and confidently predicted gold ripping past $5,000 an ounce.
Okay, we need a massive disclaimer here.
Oh, absolutely. Now, to be crystal clear to you listening, we are not taking political sides. We are not validating the specific geopolitical claims made in that advertisement, and we certainly are not endorsing a $5,000 price prediction.
We are just looking at the sources.
Exactly. We are bringing it up because it perfectly encapsulates the extreme headline-driven volatility that exists right now. The market is running on high anxiety.
It really is. And an industrial operation like Equinox has to navigate that exact anxiety. They cannot build a 30-year engineering plan based on the hope that a sensational financial newsletter headline actually comes true.
So the mechanics of how they handle that volatility are fascinating. They use complex financial instruments, derivatives, stream arrangements, and gold prepay transactions.
Right.
If you look closely at their Q1 numbers, it looks wild at first glance. Equinox delivered nearly 2,000 ounces of physical gold under a stream arrangement for only $975 an ounce.
Which is roughly 20% of the current market spot price.
Yeah. They also had to settle over 11,600 ounces under gold prepay transactions, receiving an average of $2,770 per ounce for the portion they sold on a spot basis to settle those specific contracts.
And on top of all that,
Yeah, they still hold active gold collar contracts with strike prices ranging from $2,100 on the low end to $3,487 on the high end.
those collar contracts are a perfect example of financial engineering. Think of a collar as a set of financial bumper lanes for a company's revenue.
Bumper lanes, okay.
Equinox buys an option that guarantees they can sell their gold for at least $2,100.
Right.
This protects them if the market suddenly crashes.
Right.
But insurance isn't free. To pay for that downside protection, they sell someone else the right to buy their gold if the price skyrockets over $3,487.
So they're intentionally capping their massive upside to ensure they never fall below a fatal downside.
Exactly.
Okay, I see the logic, but I have to push back here.
Right.
If gold prices are allegedly shooting the moon, if there is all this geopolitical tension driving the price to record highs, why in the world is a mining company locking itself into selling chunks of its primary product at prearranged lower prices?
I know, it seems crazy.
Right. Why give away 2,000 ounces of gold for $975 an ounce when the market is screaming for more?
It feels totally counterintuitive when the market is hot, but it comes down to the absolute necessity of institutional risk management.
Okay.
When you are a company managing billions of dollars in active capital expenditures, employing thousands of heavy machinery operators across multiple continents, and dealing with highly volatile weather and shifting geopolitics, you simply cannot expose 100% of your business to the daily whims of the spot price of gold.
You'd be risking the whole company.
Exactly. You gladly trade a portion of your potential upside for guaranteed corporate survival.
Oh, I see. So those prepay transactions and streaming agreements, those were essentially the survival mechanisms they used years ago.
Precisely. Before the Greenstone or Valentine mines produced a single physical ounce of gold, they cost hundreds of millions of dollars to blast, dig, and build.
And you can't just put that on a credit card.
No, traditional banks won't always lend you that kind of money, just based on dirt. You secure that massive upfront capital by promising to sell a fraction of your future gold at a steep discount. That's the stream arrangement.
So you cap your upside today because it was the literal only way to ensure you actually had the capital to build the mine for tomorrow.
You got it.
That brings this entire deep dive full circle.
It really does.
It connects directly back to the billion-dollar balance sheet overhaul we dissected in segment 1. They utilized those derivative contracts to survive their massive building phase. And now that they are finally pulling rocks out of the ground, they strategically sold their Brazilian assets to clear their legacy debt and finalize their financial armor going forward.
They are successfully transitioning from a developing company that had to mortgage its own future just to build its mines into an established producer that actually has the liquidity to control its own destiny.
So let's pull all these threads together for you. Equinox Gold's Q1 2026 was infinitely more complex than a 1-cent earnings miss.
Far more complex.
It was an absolute masterclass in corporate house cleaning and strategic discipline. They utilized the sale of their Brazilian assets to aggressively clear $1 billion in debt. They survived a brutal Newfoundland winter that temporarily wreaked havoc on their cost per ounce, while simultaneously proving their new physical machinery operates well beyond engineered expectations.
Yep.
They laid the groundwork for a massive $37 billion 30-year future in Mexico by patiently designing a state-of-the-art CIL plant alongside local community negotiations. And they successfully navigated the complex, sometimes painful world of gold derivatives to ensure they survived to see this quarter in the first place.
It radically changes how you evaluate heavy industry.
It does.
When you pull up a stock chart, it's so tempting to just look at the ticker price of the commodity or see if they hit an arbitrary earnings estimate. But looking at the reality of the Newfoundland winter, it leaves you with a much bigger question. If a single severe snowstorm can completely upend a quarterly cost forecast and block access to high-grade ore today, what happens to the entire global gold supply as extreme, unpredictable weather events become the new norm over the 20 or 30-year lifespan of these new megamines?
Oh, wow. That is a fascinating question to leave on. The climate itself becoming the ultimate denominator effect for the entire industry?
Exactly.
Missing an earnings target by a single penny really is just a jagged line on an x-ray. It tells you almost nothing about the true health of the patient.
Nothing at all.
The real value is buried deep beneath the ice, in the mechanics of the debt, and in the patience of the long-term plan. Thank you for joining us on this deep dive. Keep looking past the headlines, and we'll catch you on the next one.